Hi, and welcome to Aldrich Wealth's first quarter 2018 investor update and market outlook. I'm Nicole Rice, Director at Aldrich Wealth, and I'm joined by Darren Richards, our Chief Investment Officer and Partner. Darren, let's talk about domestic equities first. As you know, they had a stellar start in January, but unfortunately gave back much of those gains in the final 2 months. Can you talk a little bit as to why we saw that first quarterly decline in over 2.5 years?
Yeah, thanks, Nicole. It was a great start to the year. Really strong first quarter with the S&P up 5%. Unfortunately, it was too good. And I think what that did was it caused people to start thinking about the economy's that good. If things are going this well, maybe the Fed needs to hike rates a little bit quicker than what they've talked about in the past. And then in beginning of February, we got the jobs number, 200,000 plus jobs added, a good number. But more importantly, 2.9% increase in wages year over year. That's the highest we've had in 9 years. So all of a sudden, wage inflation is picking up, which hasn't happened during the whole entire recovery. And when wage inflation picks up, it contributes to overall inflation. Overall inflation usually drives rates higher. So all of a sudden, the economy, which had been predicting maybe 2 rate hikes by the Fed this year, 3 was on the table, and then maybe even 4. So interest rates started to move higher in a very short period of time. 10-year started the year at 2.3. All of a sudden, it was over 2.9. We had a 50 basis point jump in interest rates in a very short period of time. Made investors nervous. Some money left equities, went into bonds, some went into cash. But overall, people just got nervous about interest rates rising faster than what was priced into the overall market. We got an inflation reading in the middle of the month that confirmed inflation was rising. Rates again pushed higher. So areas of the market that are interest rate sensitive, such as consumer staples, utilities, REITs, those areas really struggled, whereas the growth sectors actually held up fairly well. So if you look at the overall returns for the market, it was down 0.75%. Growth stocks were actually up and value stocks were down. So value stocks dropped enough to kind of overtake growth, but for the most part, interest rate sensitive areas of the market really struggled as rates moved higher. This whole concept of things being too good and the Fed having to get more aggressive really scared investors. And then we had some issues in Washington with cabinet changes and tariffs, and that increased our uncertainty about what's going to happen. And as we all know, investors hate uncertainty. So investors became more cautious. So as the quarter went along, we saw a sell-off, a couple of big drops in the market. It recovered a little bit in March, but again, we finished the quarter down in negative territory for the first time, as you mentioned, in 2.5 years. And it was really things too good, interest rates rising a little fast, and a little bit of uncertainty. And investors entered the year very complacent. They were used to getting nice returns without much risk, and you saw a sell-off because of that. And that's really what drove stock prices down, the indices down in the first quarter.
Yeah, interesting. In that, you were mentioning international stocks. Let's talk a little bit about that. International stocks, as you know, didn't provide much of a buffer for domestic investors this last quarter. Can you talk a little bit about that and maybe explain why that was?
Yeah, part of the reason you have international equities is for diversification. And in a way it worked and in a way it didn't. So in the first month of the year, again, international equities did extremely well, just like U.S. equities. They were up 5, 6, 7% as well. And they also suffered a setback in February and March. However, it's for different reasons. In the first month of the year, the euro went up about 4%, the pound went up 5%. We had serious currency appreciation overseas, and that was after last year's appreciation. So it made investors nervous. You can't have a currency going up 5% a month. That's just too much. And that really made people nervous that export-centric type companies and even countries like Germany would struggle if the euro were continuing to move up fast like that. So for instance, Germany finished the quarter down 4 or 5%. It was really kind of in the crosshairs of this currency appreciation. And when that happened in January, investors again flocked away from areas of the market, international equities, because they were nervous about currency appreciation. At the same time, earnings overseas, particularly in Europe, started off kind of nice, and then they trickled down a little bit in the mid-quarter, and I think that made people a little bit cautious. At the end of the quarter, they rose back up to their expected level, but they took a little bit of a dip there in the quarter. So for different reasons, international equities didn't perform as well. If you look at small cap international, it was actually positive. So again, that tells you the currency had a big impact because that tends to be more domestically focused, not necessarily export focused. So that held up fairly well, but large cap international equities were down about 1.5, about twice as much as the 75 basis points that we lost on the S&P. Our friends over in emerging markets, again, phenomenal. On a relative basis, 1.4%, quite a bit better than the rest of the globe. Absolute, not great numbers, but still very strong performance, and really insulated from some of the issues that impacted domestic and international large cap stocks. They're trading at a discount. They have faster growth. That's part of the reason that's an attractive area. Money is continuing to move there while money was leaving U.S. equities. So emerging markets held up well. International small cap, international large cap, not as much. And The currency appreciation stabilized the last 2 months, and we got a little better performance latter. But for the most part, it was the currency appreciation that really hurt the international equities.
Thank you. Let's shift maybe over to fixed income now. So as you know, the Fed raised the overnight rate by 0.25%. Unfortunately, we saw that fixed income returns actually went negative, unlike the last quarter of 2017. Can you explain why that was? Why did we see bond prices fall this quarter?
Yeah, exactly. So the Fed raised rates last quarter, and they raised rates this quarter the same amount. Totally different results. Last quarter, bonds actually were up 1.5%, even though interest rates were raised 25 basis points. This quarter, bonds were down 1.5% with the same rate hike. What happened this quarter was, unlike last quarter, when the Fed raised rates, all interest rates went up. Last quarter, short-term rates went up, long-term rates actually went down a little bit. So if you look at the 10-year Treasury, last quarter it was flat. If you look at it this quarter, 34 basis points higher. And when interest rates go up, bond prices go down. So this is really the first time I think that the market said, okay, the Fed raised rates, and it impacted the long end of the curve, the longer dated securities, because the reason the Fed raised rates and the talk was inflation was picking up. And that really impacts all bonds, not short-term duration bonds. So really a switch in the way people kind of looked at the overall market. And I think we factored in at least one more rate hike in 2018 that wasn't factored in earlier. And that's, again, helped push rates higher. So the 10-year, the 30-year, the 5-year, they all went up, where last quarter anything past about 8 years in duration was flat, and yields did not move higher, and bond prices didn't move lower. So the curve shifted in a different way, and it impacted returns in a negative way. So that's more normal what happened this quarter than last quarter. Last quarter was a bit of a surprise, but nonetheless, I think investors are factoring in 3+ rate hikes this quarter, and now that's happened in a short period of time. And we saw the 10-year again go up 34 basis points, which you can imagine if that happened every quarter, we'd be looking at almost 1% a quarter, which would be a very, very large move. So I don't expect that to continue, but it was a big move in the first quarter.
Great, and you've just mentioned your expectations. So ironically enough, last quarter you had some predictions. You said that we would see increased volatility in 2018, that we would see interest rates rise, that we would see equity returns actually decrease a little bit or be more minimal. And those predictions were actually accurate. So has your outlook changed for the rest of the year?
Well, first of all, I'm sorry they were correct, because that wasn't a perfect environment for us, and I wasn't expecting it to happen so abruptly. So the interest rate, at one point, the 10-year Treasury was up over 50 basis points. That's a very, very large move. It happened in a short period of time. Volatility went from extremely low to very, very high levels in just a matter of a few days. And last year, I think we had 7 or 8 1% moves in the S&P up and down for the whole year. We had 15 1% moves in the first quarter. So volatility came back with a vengeance. And obviously equity prices were down. So we were correct in those areas. I didn't expect it to come all at once like that. I thought it would be a little more gradual. So I still think interest rates will rise. I think that'll continue, but I think it'll be at a much more gradual pace, maybe more palatable. And to some extent, I think the market's now expecting it, so it should have less negative impact. I expect equities to perform positively. I don't expect them to be negative, and I think that, again, the sudden move in rates is what caused them, returns to be negative versus positive, because earnings are expected to grow 20 to 25% this year. Valuations started the year at 18.5 times earnings for the S&P 500. They dropped to 16 because prices have been stable and earnings have gone up. So stocks went from relatively expensive to actually average to below average. So they're attractive again. So you would anticipate in this kind of environment normal type returns, that 8, 9, 10% type return for the rest of the year. Volatility is going to be high. It's not going to probably see what we've seen. We're not going to have 1,000-point moves in the Dow in 1 week like we did, but I think we're still going to see volatility because the uncertainty, what's coming out of Washington with trade, cabinet positions changing. What's the Fed going to do? We have a new Fed chairman. Are we going to have 3? Are we going to have 4 rate hikes? There's still uncertainty in the market, so we're going to see more volatility. But overall, I don't think we're going to have a repeat of what we had in the first quarter. I think that was a very strange quarter. The economic data still looks so solid that it'd be hard to imagine an environment where over the next 3 quarters we don't have positive returns in equities. Bonds, that's kind of a crapshoot. We're down 1.5 in the first quarter. We'd probably be lucky to have positive returns for the year right now based on that. So I'm not optimistic about bonds, but you have them in your portfolio to protect against something bad happening, and this, that's still a probability could happen. That's why you hold bonds, but you're not going to make much in that segment.
Great, thanks, Darren, and thank you for joining us for Aldrich Wealth's first quarter 2018 investor update and market outlook.